Good afternoon. Hi there. I'm Dean Heskin, President and CEO of Swiss America Trading Corporation. Today's date is January the 12th, 2022. Happy New Year to you all. I have on the call with me today, Dr. Jerome Corsi. And today what we'd like to discuss is a topic that has been thrown around here in the news here recently, maybe a little foreign to some of you out there, as it's a kind of a niche term, if you will, and that is financial repression. Most of you are familiar with what price inflation or financial inflation is, meaning prices go up. Financial repression, there are some similarities, but it's inflation to some extent with a little bit of a twist. And Dr. Corsi has done a ton of reading, a ton of talking, even writing on this topic. And I felt it'd be a great opportunity to bring him on and kind of discuss this and kind of from three different points or three different directions. One, what is it? Define it. Tell us what financial repression is. Two, what does it mean? What does it mean to you and I? What is it going to do to us, if anything? And thirdly, what's the solution if there is such a thing? Meaning like if there is some kind of a consequence or if there is some kind of financial direction that occurs as a result of this, what can you and I as individuals do? So with no further ado, Dr. Corsi, how are you today?
I'm doing great, Dean. Good to be back with you. Looking forward to the discussion. I think you outlined a really interesting set of talking points here, and I'm looking forward to getting into it.
Fantastic. Well, for starters, can you tell us what exactly is financial repression? What does it mean?
It's an important term. Financial repression means that when the government is getting into massive amounts of debt, the debt has to be serviced. You have to pay interest on it. So the recent tricks of government have been to essentially keep interest rates at zero, in some cases below zero. And the Federal Reserve has been doing this through what they call quantitative easing, which has been a massive buying of our own government debt, both the Treasury debt and also mortgage-backed securities, with the goal of suppressing interest rates, keeping them at zero, which makes the cost of servicing the federal debt cheaper because you're not having to borrow so at such expensive rates in order to pay off the interest that's due on the debt you already have outstanding. And that represses, it's called financial repression because it hurts savers. If you're not getting any interest rate on your savings, you're in a sense subsidizing the government's paying off of this massive debt. You're actually paying for the debt for the government. And the rub on this is a couple of things. Number one, it certainly severely damages the ability of savers to appreciate their capital in dollars. And savings in traditional economics has been the base of expansion of capital. You have to have savings in order to produce economic growth. And this jeopardizes that. The only way we're producing economic growth is to borrow in order to stimulate growth. And because we can't stop inflation, which is, I think, the key situation today, your dollar is depreciating. So you've got dollars depreciating because of inflation. You're getting zero interest rate on your savings, which is also, you're subsidizing the debt, which is continuing. And at the bottom line of this is, I don't think the Federal Reserve has any tools left in order to control inflation. And this is going to be a loss of dollar purchasing power, where I think suddenly this issue of financial repression has got to be center on the table.
Got it. Well, you know, Dr. Corsi, as well, in my research or reading more up on this topic, some of the things, you know, as we kind of the second point, as I outlined in the beginning, you know, what does this mean? What does financial repression mean, and what does it do? Some of the things that I found that described it talked about an erosion of privacy, an erosion of wealth. You know, start talking about how this is one of those tools that, as we've heard a lot about the middle class shrinking, this is a tool that kind of feeds into that whole dynamic. People not being able to retire. I mean, is there any other perspective that you have on what the real life consequences of this would be to the average family out there?
Well, I think it's extremely serious because not only is the Biden administration talking about keeping interest rates at or near zero. And I want to discuss that in a moment. I don't think it's going to work. But the point is, even with traditional savings vehicles like IRAs, 401ks, the government is looking at ways in order to tax that money. And certainly if anyone, violates the rules, one of them, which is very vulnerable that we've talked about, is holding actual physical gold and silver in an IRA. There's very strict rules on that. Swiss America knows the rules, but many investors who have gone for various schemes are vulnerable to very severe penalties from the IRS. The IRS is going to exact those. So I think we're in an environment that's very hostile to savings right now. And this is a major concern when today, in fact, this podcast is really timely because today we just got the announcement the consumer price index for November, this November 2021, just a couple of months ago, was now it's 7% rate. And this is no longer, you can't say this is temporary anymore.
Sure.
And so the Federal Reserve is in a problem because now traditionally the Federal Reserve is going to say, well, we better back off of quantitative easing and get ready to raise interest rates. In fact, at the last Federal Open Market Committee meeting in December, it's what the Fed said. But the problem is they didn't cut it that dramatically. We're still going to have about $20 billion in government debt every month that is under quantitative easing. And that tool is no longer available because if the federal government doesn't buy its own debt, then interest rates are going to have to start rising in order to finance the federal debt, to find buyers for the Treasury securities and the government-backed mortgage securities. And with interest rates rising, the inevitable impact is going to be to hurt the economy, to slow down the economy. And so the government's in a real bind. It cannot allow interest rates to rise. But when we got into the stagflation in the late 70s with Jimmy Carter, Paul Volcker, as you'll recall, had double-digit in interest rates, and he dramatically reduced economic growth. And today we don't have the freedom to do that because in 1979 through 82, our government debt was significantly less than it is today. And today it's like having a car or a pickup truck pulling a load that's 3 times as heavy. And you just can't add more speed to the pickup truck because it's already maxed out. Whereas in the 1982 sequence, we had a lot of room to go in that pickup truck. We weren't carrying 7,000 pounds in a trailer. We're carrying 2,000 pounds in debt. And we could afford an interest rate increase without absolutely causing a depression. Today, I think the Federal Reserve's in a real bind.
I would agree. And Jerry, you touched on something just a moment ago about how the government is basically involved in this process. And the reason I mentioned that is, at Swiss America for 40 years now, we've specialized as one of the leading companies that deals in physical, tangible assets by way of gold and silver. And one of the motivation for many people getting into our type of market is by having gold or having silver, physical metal of some kind. It is an unencumbered by debt asset, meaning like it is what it is. It's got a value based on what it is, not only in US dollars, but in franc and yen and lira and pounds. And I guess what I'm asking here, if you would maybe elaborate, if you'd like to, or you can, again, in the reading I've done on this topic, one of the ways that financial repression pretty universally has been explained is that it's the government's way of taking control of a nation's economy and financial system. Is that something that you have some perspective on or could elaborate on for us?
Oh, absolutely. Because you see, your savings are in dollars. And if you can't get first of all, you can't get interest on your savings, so you're not appreciating. Secondly, in this context of high inflation, the purchasing power of the dollar is being eroded dramatically. And if all your investments are in dollars, you can take the real value of those investments and begin reducing them by significant percentages, because they may have a dollar value, but that dollar value is not going to be a purchasing value. So you really have lost, and the government's essentially taking control of your ability to live a reasonable life, because your money is becoming increasingly worthless. Whereas if you have gold and silver, it's just the reverse. You've got tangible value that's going to appreciate because it's not valued in today's dollars. It's valued in tomorrow's dollars, because it's going to take a look at what gold has appreciated since we came off of the gold standard of the Nixon administration to today. It's been dramatic, despite gold being still a manipulated market. And I think just like the Fed's losing control of the ability to raise interest rates, the central banks are losing control of the ability to suppress the value and the price of gold and silver, because they are virtually one of the only things you can own that is outside the dollar valuation methodology. And you've got to have assets outside that methodology. Otherwise, the government's going to control your entire existence.
Well, and I certainly agree with everything that you're saying there. And, fortunately, we're living in a period now where it makes perfect sense for people to own stocks. It makes perfect sense for people to own real estate. They're both doing fantastically well. Metals have been holding their own, but I do understand and appreciate the underlying theme there is that diversification. Having something like metals certainly makes sense, because again, it is something that you can talk about it from decade to decade, generation to generation, because the gold that the good Lord himself put in the ground many, many years ago is the same gold that we're looking at today as we brought it up above ground. So the value is a pretty lasting value. But one of the things that you mentioned there, that, and as you were talking, it was kind of like a wow moment. Basically, it sounds like financial repression almost is a fancy word for taxation, because really you are just taxing people, these retirees or people who are near retirement, who've put money away, so that they can now, enjoy the remaining years with their family and do what they like to do after many years of hard work. This financial repression, which we're referring to it as a government tool to, kind of control the economy, what in effect it's doing, it's just dipping into, in many cases, like retired or near retirement type people's pockets. Is that a safe way of saying that?
It is. And there was a report out today also that real wages, real income is declining in America. And again, I think this is part of the problem of when you have value in dollars, and the government now is so desperate to essentially grab all the dollars it can get. And there may be a limit to what the government can do with taxation, but suddenly you've got X amount of money in savings. And today or yesterday, that bought X amount of goods. Well, in the next period of time, starting now, it's going to buy X minus some element of goods, because you're going to buy less with that money. Same dollars, less purchasing. And secondly, I'm saying that I think I see shaping up a crash in this economy, because if the government cannot continue to sustain these debt levels and issue them and buy them in the Federal Reserve, if we're going to have to let interest rates go up in order to control runaway inflation, we're on the doorstep of double-digit inflation. And so if we don't have that tool anymore, we're going to be in a situation where the government is going to, just to finance the debt, which it has to do, it's going to be increasingly putting in measures that are going to suppress the economy. So you're not only going to have a hit in that your savings are being repressed, but your earnings are going to be repressed. and your investments are going to be repressed. The entire dollar base, it's kind of like if the dollar is the ocean that sustains all these investments, that ocean's now going, the government's forcing that ocean down. All the boats are going lower in the water, to the shore. And I think that's one of the reasons why I'm looking at tangible assets. Diversification is always a good strategy, but there are times when I believe you can say that markets are going to be more difficult to continue this growth. Debt sustained growth is not long-term sustainable. That's the bottom line equation. And when you enter these markets, it's time to really think, I've got to have a hedge against that. And a hedge is tangible value. And at the top of the list is precious metals, gold and silver.
Well, it's interesting you mentioning it, and like we said from the beginning of this podcast, in this call, the word inflation and financial repression of the terms tend to kind of cross each other in a manner of speaking. In fact, I was reading mid part of last year, a well-known author as well as investor, Russell Napier, I believe that's how you pronounce his name, had actually written about this topic. And one of the caveats with financial repression, he explained it, and he said, there's a healthy aspect to it in terms of what it can do for the economy. But he did kind of highlight the fact that if inflation were to flare up, that would present a problem for this financial repression model. And he didn't see inflation as something, again, going back to mid part of last year, as something that was going to be a problem in the foreseeable future. But yet, as we talk today, all over the news, CNBC, I was watching, they asked all the talking heads, first off, the inflationary figures that have just come out, as you alluded to, these are the highest inflation rates that we've seen in 40 years. And the question was posed to each of the people on the panel today, can the Fed address this inflation problem without tanking the economy? And unanimously, the answer to that was no. And so it puts us in a very compromised position, Jerry, where I think it's leading into the selfless plugs that we've been doing for the precious metals market and our arena, where having a well-diversified portfolio or having some metals in there certainly does make sense. But, also understanding, what is happening out there, because we do have markets such as real estate, such as stocks, that are at record levels really right now, by and large across the country, meaning real estate, stocks, they are what they are. And if there is some kind of a fallout with this financial repression or price inflation kicking up, what do you see as a potential consequence to people if something were to occur?
Well, I think people have got to be very concerned about their ability to maintain standards of living. And that's going to become an increasing problem. When the government is proposing budget deficits in multiple trillions of dollars, and I know we've got this new monetary theory that says you can issue fiat currency that way. You can, but you can't impose the taxation you need to impose in order to compensate for the inflationary effect of that deficit spending. And now I don't think you can, in terms of debt service and the magnitude of the debt, I don't think you can afford to allow interest rates to go up very high. If the inflation can't be controlled, what are you going to do? I mean, this is where the choices, economics is determined by certain laws of how things work economically. And wishing won't make it so. And the Fed saying this is only temporary because of the pandemic. Well, that didn't prove to be true. And now we've got the fundamental laws of economics taking over, and people need to start thinking about financial repression to realize how the government's stealing your money. Government's stealing your purchasing power, stealing your value, and they're doing it in a stealth fashion. That's what's so insidious about this concept of financial repression. People need to be aware of it. They need to devise strategies in order to protect themselves in this kind of an environment.
Well, and there you go. And that's our third point. What is the solution? And you just hit the nail on the head. People need to be aware of it, need to understand it, and they need to be putting solutions in place to not fall victim to it. Well, Jerry, I thank you. This has been I think a very enlightening conversation for myself, and I hope for those tuning in and listening to us. This is something that as the situation continues to develop, we can certainly weigh in again and watch and see what happens if we do start to see a rise of inflation, which, as we discussed, we can't afford to happen right now, or if we see continued financial repression, what kind of a consequence that's having on people. We will continue to monitor this. And again, as the topic warrants or necessitates, get back together and discuss it. So this has been Dean Heskind, President and CEO of Swiss America, with Dr. Jerome Corsi. Thank you so much, Jerry. It's been fantastic sitting down with you once again. And today, as I mentioned, is January 22nd, January 12th, 2022. A lot of twos, Jerry.
A lot of
Easy to
twos.
get confused. If you'd like some more information of anything that we've discussed today or other things pertaining to the metals market, please feel free and visit us online at www.swissamerica.com. If you have any questions or like any feedback, we actually have a contact tab there on the site. Please reach out to us and let us know what's on your mind. Thank you so much. Thanks for tuning in, and we look forward to speaking with you again sometime soon.
Thank you, Dean. Look forward to joining you the next time.
Thank you.